Manish Kumar, CIO and EVP of ICICI Prudential Life Insurance, joins us. Manish, good to have you. Thanks so much for joining in. What's the base case scenario, Manish, over the next month and a half? News flow would be positive, or it would remain iffy with the earnings season as well as the RBI policy slated to come out in the next 30 days?
Within the next 1 to 2 months, we expect markets to sort of remain very range bound, because on one side technically it appears to be on a very strong footing. If we look at the flows globally, there is a risk trade that is on for the last 3 months, and any sign of positive news that emerges on the domestic front, there is a tendency to buy into stocks. On the other hand, fundamentally there are challenges on the horizon, be it in the form of the huge current account deficit that we are running, because of which there is constant pressure on currency, causing RBI to intervene, because of which liquidity in the banking system is remaining tight. There are challenges on the growth front, and then the earnings season is also likely to be mixed. So taking into account both the technical and the fundamental factors, we are inclined to believe that these two will probably keep on conflicting each other for the next few months.
Manish, hi, morning. I also want to talk about, GAAR and the contours in terms of what it implies for FIIs as well as P-notes, because the market shakes each time the finance ministry even mentions that word.
Well, to be very honest, principally one cannot argue against the merits of GAAR. And the reason we are saying that is, after all, if you are coming to invest and make money by investing in this country, there is no harm in sharing a part of your profit with the country. Also, if I were to invest in individual capacity, I am also entitled to short-term capital gains, or rather, I am actually liable for that. So somewhere trying to say that if you are actually investing with a short-term horizon, you could be subject to short-term capital gains tax. Principally, we find it difficult to argue against the merit of that. Also, given the fact that the government's finances are not in the best of shape, if they are trying to say that, look, if there are any tax havens where you are trying to take advantage of to cut your tax burden, then that is something we would like to put a curb on. However, the timing of this measure can always be questioned. At the current, in these times when the country is running huge trade deficit and consequent high current account deficit, whether we need more capital flows is something that we need to focus on. And therefore, instead of trying to say that, look, this is something which could be implemented from 1st of April next financial year, we can probably have a time-bound program so that everybody has a clear idea of the time frame when these things will be applicable. So some clarity on this would be welcome, rather than trying to simply criticize this measure.
So what is the biggest fear when it comes to GAAR and what it means for P-notes, Manish? Do you fear that there is going to be large-scale unwinding that we are going to see, and withdrawal of money from ETFs as well? Because CLSA came out yesterday and said that they are going to actually not build onto their P-note book.
Our understanding is that in the last few years, the percentage of flows coming through the P-note route has come down dramatically. And while some volatility cannot be ruled out in the short term, in the long term, this would probably make the markets more healthy, as it would mean better quality of money flowing through the right kind of vehicles. So, as I'm again repeating this, that probably instead of trying to say that we are going to implement it outright or immediately, probably if we can give some kind of time frame, and if we can clearly indicate that, look, from this time onwards, money coming through these vehicles in these forms or through these tax-free havens, they will be subject to short-term capital gains tax. That will be able to that would take care of any short-term volatility that can actually be faced by the markets.
Manish, in light of that view, how do you view individual pockets shaping up over the near term? I'm guessing it's probably difficult to take a call on the medium term considering the volatility, but the near term. Metals, let's start off with that. It's what's happening to the global commodity prices as well. It's very volatile, but the stocks have come off quite a bit. Is there an investment argument here?
Metals is one sector where we had taken a tactical overweight call few months back, and that has played on in the last few months. On one side, if we look at the global economic paradigm, we are actually seeing some improvement in most of the data that is coming from the West. On the other side, we have China, where news flows continue to be mixed. Also, the liquidity paradigm seems to be quite benign globally. And what we have seen is that typically when the liquidity paradigm is benign, and when the news flows on the global economic front is also good, typically metals as a sector does well. So the catch here is to follow the Chinese economy very closely, and if we see Chinese economy actually only moderating a bit and not really getting into any kind of hard landing, then probably metals as a sector can do well even from here onwards.
Okay, that's metals. What about banking, Manish? How do you view the large cap PSU or private sector banks doing, particularly in light of what the RBI is saying as well? They're being extremely non-committal, so to say, about the policy rate action. What do you do with banking now?
Let me try and give you a perspective on how we have been historically placed. Within the banking sector, there have been certain private sector banks where structurally we have been overweight, and that has really helped us. As far as the other side of the pack is concerned, which is the PSU banking space, we have always been taking some tactical calls there. And in the current scheme of things, we would like to be overweight the private sector banks and maybe neutral to underweight the public sector banks. And there are reasons for saying so. One, while we expect some softening from RBI, the extent of easing may not be as much as probably being priced by the market. Second, because of the fact that the interest rates are still running very high as far as the real economy is concerned, the challenges on asset quality would remain, and those are more likely to be faced, I would say, more severely by the public sector banking space, and therefore the call.
So Manish, what is it that you're liking given the market dynamics that we are working with? Would it or rather would your bullish portfolio include some contra names, the likes of cement, or perhaps some consumption and defensive names as well?
Well, it is going to be a combination of these. Typically, we take, you can say that roughly 70 to 80% of our exposures are strategic in nature, where we really do not make any significant changes. And yes, there are certain tactical exposures that we take. As far as cement is concerned, we no longer would like to call it as a contra exposure, because cement has been actually in favor for last couple of months. In fact, that is one sector where we as a house had gone overweight about 18 months back, and that has done quite well for us. Going forward, at the current valuations, whether it makes sense to really go overweight, we are not too sure on that. At the same time, yes, there are certain defensive sectors as well where we would like to be positive, and one such sector is the pharmaceutical sector. That is one sector which has seen fairly steady growth over the last few years, and in the last 1 year, while the stocks may have done better than the markets, they haven't given any significant absolute returns, and therefore the valuations look more reasonable now than in the past, and the growth paradigm also looks fairly secure, considering the fact that we are seeing a lot of growth challenges in other sectors like capital goods. So that is one sector that we would like to be positive on.
What about the consumption theme, the likes of the entire auto sector, not just that, some popular names like Jubilant Foodworks, Titan, TTK Prestige? Are valuations still a concern when it comes to the consumption theme, or would you bet big on growth?
Well, it will be difficult for me to comment on individual stocks,
sure,
but let me talk about the consumption theme. And within that, actually there are two sub-themes. One is the consumer discretionary sector, which is basically the automobile sector, which is also interest rate sensitive. And then you have the FMCG segment, which is, you can say, a pure consumption theme. Now, we have been overweight on the consumer discretionary sector over the last couple of years, and if I have to really play overweight any interest sensitive sector, then we would like to prefer consumer discretionary over banking, because the challenges of asset quality do not exist in this sector. Yes, there are challenges of growth, but again, we are taking a slightly longer term view, and we believe that we are at a phase where even if the growth were to tactically slow down over, say, for a year or two, yet over a 5-year horizon, the growth will be in double digits. As far as FMCG is concerned, that is one sector, while we are positive on the performance, we believe that that sector is quite expensively priced, and therefore we would like to be underweight purely from a valuations perspective.
Okay, Manish, one final word really before we let you go. In light of the current scenario, what is it that you're the most bullish on, and is there something that you will definitely avoid?
One can take a look at our portfolios, and I think I've already said that the sectors like private sector banks, consumer discretionary, certain companies in the telecom sector, and pharmaceuticals. These are the 4 sectors that we would like to really go for.
Now, what would you avoid, Manish?
Capital goods is one sector where clearly we would like to be underweight, and then FMCG primarily on grounds of valuations, and to some extent we would also continue to avoid the real estate sector.
Okay, Manish, appreciate you taking the time out, and really good to have you on the show.